Welcome back to the gold standard, your signal in a noisy metals market.
Good to be here, Marcus Blackwell, and good to have all of you tuning in with us.
You know what is fascinating? Gold just swung more than $80 this week on Iran. Welcome back to the gold standard, your signal in a noisy metals market.
Good to be here, Marcus Blackwell, and good to have all of you tuning in with us.
You know what is fascinating? Gold just swung more than $80 this week on Iran conflict headlines and ceasefire rumors, a textbook case of safe haven whiplash.
The important thing to understand is how central banks shifting from steady buyers to occasional sellers may be muting some of that geopolitical shock.
Exactly. We'll also dig into market structure, from GLD outflows into lower-fee ETFs like AAU to what volumes above $250 billion in futures are telling us about the path towards $6,000 gold.
Right. This leads us to silver and the miners, with First Majestic's sharp move and Pan American's project plans showing how these stocks can double the metal's volatility, for better or worse.
Building on that point, we'll finish with strategy, translating gold's 14% monthly drop into concrete risk rules, staggered entries, and exit levels that keep both nerves and portfolios intact.
So think about it this way. Whether you're cautious capital preservation or aggressive trader, there's a playbook here for you.
All right, Sasha Reyes, let us move straight into Segment 1, Gold Price Action and Geopolitics.
Segment 1 starts now with this week's war headlines and what they really meant for the gold tape.
Gold spent most of the week grinding sideways, then ripped higher about 3% in a single session before giving a big chunk back as traders reacted to every twist in U.S.-Iran peace talk headlines.
And that spike really lined up with one headline in particular. Iran warned it would escalate if sanctions were tightened, while U.S. officials floated a narrow ceasefire framework, all in the same news cycle. To put this in perspective, that kind of mixed signal is gasoline for safe haven trades.
Exactly. Think about it this way. Traders went from war risk is capped to wait, this might blow wider in a few hours. That jump was classic dip buying after gold had cooled off, but it was supercharged by fear that the conflict might spill into shipping lanes and energy prices.
Right, and then you get the whiplash. A few hours later, back-channel talks in Oman, possible de-escalation framework leaks. Suddenly, that safe haven premium bled out, and gold gave back gains in the afternoon session.
The key insight here is that the path of prices, not just the closing level, was driven almost tick for tick by war headlines, ceasefire rumors, and comments from negotiators.
And to think about what that tells us, this was less about slow, fundamental positioning and more about short-term money crowding into the same trade. News pops up on Bloomberg and social feeds, algos pick it up, and human traders follow the same risk-on, risk-off script.
Here's what's interesting. Safe haven demand is not a single thing. You have fast money and futures and options chasing momentum, and you have slower money like ETFs and central banks deciding whether this is a structural risk or just another flare-up.
Here's why I want to push on that, because a lot of listeners assume more war equals more gold. The important thing to understand is there are scenarios where a drawn-out conflict actually weighs on gold instead of helping it, especially if it bleeds into growth forecasts and currency stress.
That is a good challenge. One example is if the Iran conflict drags on just enough to hurt global growth, but not enough to cause outright panic. In that case, real yields might stay elevated as central banks fight inflation, and that can cap gold even with ugly headlines.
Or markets may decide the war is contained. We have seen that pattern before. Initial shock, safe haven spike, then a slow drift lower as traders treat it as background risk. Volatility collapses and all that hot money bails out of their hedges.
Also, safe haven demand competes with liquidity needs. If sanctions tighten and emerging markets feel pressure, some investors sell what's liquid to cover losses elsewhere. Gold can get caught in that because gold markets are deep and easy to trade.
This leads us to the central bank angle, which becomes important here. On paper, Iran war risk and sanctions on the region should make official buyers in Asia and the Middle East more interested in holding metal they can store outside the dollar system.
Yet, we've started to see a subtle shift. Bloomberg has reported that a few central banks which were steady buyers last year are now pausing or even trimming reserves, partly because of local currency weakness and balance of payments pressure.
So instead of blindly adding to gold every month, some of them are asking a harder question. Do we really want to lock up scarce reserves in an asset that doesn't generate income when we're fighting currency outflows? It becomes a trade-off between safety and flexibility.
Exactly. And that trade-off matters because central banks have been a big, consistent source of demand in this cycle. If that floor under the market starts to wobble, then war headlines alone might not be enough to sustain every spike.
You know what's fascinating? The same Iran headline can mean two totally different things to two types of buyers. A futures trader sees a chance to ride a fast move. A reserve manager sees another reason to diversify, but may be forced to wait because they need cash.
And that explains the pattern we saw this week, where intraday moves were violent, but longer-term positioning data still shows only gradual changes. Big holders are cautious about chasing every headline.
So if we zoom out, the framework becomes clear. War risk, shaky peace talks, safe haven spikes, and then this quieter story underneath about some central banks stepping back a bit. Does that make sense? That mix sets up a very different market than the one we had when official buyers were almost one way.
Which raises a key question for investors watching these charts flash red and green. If central banks and other large players are starting to change how they respond to the same headlines, how are the rest of the flows in the gold market adapting? With that in mind, I want to zoom in on the plumbing behind those price moves. The first big shift is central banks going from relentless buyers to, in some cases, net sellers.
Right, let's think about this. It's a real change in character. For years, official sector demand felt like a one-way bid.
Exactly. Take Turkey as a case study. They built up large gold reserves, then had to dump a meaningful chunk into the local market to meet domestic demand and stabilize the currency. That turns a structural buyer into forced supply.
And when a central bank sells, it's not like a retail investor trimming a few coins. Here's why this matters. These are multi-ton decisions that hit wholesale liquidity.
Here's the thing. Those tons don't usually hit the London market in one splash. They are often swapped, leased, or sold gradually. But the signal is loud. Price is now high enough that some governments are prioritizing flexibility over hoarding.
Which means future geopolitical shocks have to fight through that overhang. The important thing to understand is if a country knows it may need to raise dollars quickly, gold becomes a balance sheet tool instead of a pure trophy asset.
So flows from central banks are flattening. The question is, who takes the other side? Increasingly, it's not just bar and coin buyers, it's the ETF crowd.
This leads us directly to the GLD versus AAU story. Thoughtfully, GLD is the giant, with tens of billions in assets and very deep daily trading volume. It's the default ticker on people's screens.
But GLD also has that management fee near the upper end for large gold funds. AAU comes in cheaper on fees, and some investors care a lot about that drag over a 10-year horizon.
What's revealing is that many advisors aren't saying sell gold. They're saying keep the exposure but rotate vehicles. So you see GLD losing shares outstanding while smaller, lower-fee funds see inflows.
And that can look bearish if you only watch one ETF. You see redemptions, assume people hate gold. In reality, it might just be a cost optimization trade.
Liquidity is the trade-off. GLD can absorb big institutional orders without much slippage. AAU is plenty liquid for most individuals, but a hedge fund trying to move hundreds of millions might still prefer the larger pool.
So the key insight here is that ETF flows are giving a more nuanced message. Some hot money leaves on every spike, yes, but longer-term capital is often just sliding along the ETF shelf rather than exiting the asset class.
And against that backdrop, you have the big, bold calls. UBS and others are talking about gold eventually pushing past that 6,000 mark.
Right, and those forecasts usually sit on a 3 to 5 year horizon. The bullish case stacks several pillars: persistent fiscal deficits, sticky inflation risk, central banks still holding historically large allocations even if they pause, and constrained mine supply growth.
Plus, there's the negative real yield piece. If inflation expectations move faster than policy rates, the opportunity cost of holding gold drops, which historically lines up with strong rallies.
The more aggressive analysts argue that in that world, GLD is actually under-owned in big portfolios. They see every dip as an accumulation window rather than a warning sign.
I like the ambition, but we should stress the risks here. Think about it this way. If we get a clean disinflation, stable geopolitics, and higher real yields, those six-figure target notes start to look optimistic.
Also, if more central banks follow Turkey and sell into strength, that caps the upside for a while. Structural sellers on rallies can slow the march toward any round number target.
And related to this is the currency angle. A sharp dollar bull run can pressure gold in the short term, even if the long story stays intact.
So maybe the practical takeaway is this. Treat the 6,000 narrative as a scenario, not a promise. Position size so that you can be wrong on timing without blowing up your plan.
Think about it this way. Gold can still work as a hedge even if it never hits that headline number. The role in your portfolio matters more than the exact top tick.
And that ties into something else. A lot of investors are no longer looking at gold in isolation. They see it paired with silver as a metal sleeve.
Exactly, which raises a great question for the next part of our discussion. If money is rotating within gold ETFs and some central banks are under pressure, are we already seeing that spill over into silver prices and the mining stocks tied to them?
Shifting gears, silver has quietly stopped being the sidekick and started stealing scenes. Spot prices have jumped hard over the past few weeks, and outlets like Kitco and The Street are already calling it the trade for the second half of 2026.
Right.
Shifting gears, silver has quietly stopped being the sidekick and started stealing scenes. Spot prices have jumped hard over the past few weeks, and outlets like Kitco and The Street are already calling it the trade for the second half of 2026.
Right. The story has moved from gold mania to silver catch-up. When you see those headlines, you have to ask, is this durable or just a momentum echo of the gold move?
Here's why this matters. The miners are voting with real capital. First Majestic popped around 7% in a single session on the back of that silver strength. That is not a sleepy move for a producer.
That type of spike tells you traders are already front-running higher silver prices. But it also tells you how crowded this theme can get. A 7% move up can just as easily become a 10% air pocket if silver gives back a few dollars.
Exactly. And then you have Pan American Silver planning roughly a $1.9 billion project. The important thing to understand is companies do not greenlight that kind of CapEx unless they see a multi-year price deck that justifies it.
Or unless management is overconfident at the top of the cycle. Think about it this way. The mine can't walk away if silver drops, but shareholders can.
So here's why this matters. Miners magnify your silver view. If spot rises 20% over a year, a well-run producer might move 40 or 50% because of operating leverage.
And the inverse is true when the tape turns ugly. That's why I lean towards layering into spot silver or a broad ETF first, then adding miners only as a smaller satellite, not the core.
Building on that point, there's another twist from the gold side. Now let's consider what we discussed earlier. Stressed central banks like Turkey have had to sell gold reserves to plug other problems. That kind of forced selling can push some investors to rotate into silver instead.
Almost a psychological hedge. They see official gold flows wobble, so they say, fine, I'll chase the high beta cousin. The risk is they trade one source of volatility for an even sharper one.
And here's what's interesting. That cross-metal rotation can feed on itself. Money leaves a big gold ETF, some of it shows up in silver miners, and suddenly those names gap higher on fairly modest order flow. Which feels great right up until policy or rates shift and both metals correct together. That is the link I want people to keep in mind. Silver surge and those mining pops live in the same volatility family as gold's whiplash.
So in the next part, we will move from spotting these swings to building a rules-based plan. The important thing to understand is how to size positions, stagger entries, and avoid bailing at the worst possible moment when that volatility finally bites.
With that in mind, I want to straight to the pain point. Gold is down more than 14% this month, and silver is feeling the same pressure from higher yields and a stronger dollar. For someone staring at that drawdown on their screen, the question is simple. Is this a bear market or a reset inside a bigger uptrend?
Right, that is the question. Let's think about this. Sharp corrections during big bull runs are normal when real rates jump and the dollar rips higher. The pattern we're seeing looks more like a reset than the start of a long grind lower.
So walk us through that. When you say pattern, you're talking about those classic dip buying attempts we keep seeing around key support levels, then the rebound, then another flush.
Exactly. To put this in perspective, after a big run, you often get a 10 to 20% air pocket. First leg down, brave buyers step in, price bounces, then new macro data hits, yields push up again, and you get a second leg that scares out latecomers. Historically, those double dips during strong macro uptrends have been pauses, not the end of the move.
Here's the thing, though. In real time, every one of those corrections feels like the top. So how does an investor avoid panic selling at the worst possible moment?
This is where you need a playbook. Let's think about this in 3 layers: staggered buying, position sizing, and exit rules. If you only remember those 3 words, you're already ahead of most people.
Let's start with staggered buying, because a lot of listeners here buy the dip and translate that into go all in on the first red day.
Which is exactly how you blow up your risk budget. Here's why this matters. Decide what percentage you ultimately want in gold or silver, then split it into 3 or 4 tranches. First tranche on the initial break, second if price falls another 5 to 8%, final tranche only if you see full-on capitulation.
So you're pre-committing your plan instead of negotiating with yourself when the market is moving.
Yes, and this leads directly to position sizing. If your long-term target is 10% of your portfolio in precious metals, you don't start there day one. You might begin with 4 or 5%, so that even a nasty drawdown is uncomfortable but not portfolio breaking.
That is a key insight. Pain tolerance sets the ceiling on your allocation, not the forecast you're most excited about.
Exactly. The important thing to understand is if a 15% monthly drop has you losing sleep, your position is too big. No strategy survives if you cannot stick with it.
That brings us to exit rules. The big money is staying with the gold trade despite these shakes. How do everyday investors copy that discipline without getting stubborn?
Good question. Let's think about one approach. Separate time horizons. For long-term holdings, you exit when the macro story actually changes, not just because price is down. For trading positions, use a simple rule such as cutting if price closes below a key moving average or below your original thesis level.
So you might have a core gold position you almost never touch, then a smaller tactical sleeve that you trade around support and resistance.
Exactly. Think of the core as your insurance and the trading sleeve as your opportunity bucket. That way, you're not forced to dump the whole position into weakness.
Before we close this out, I want to give listeners something very concrete. For the cautious investor, what is the one thing they should do in this environment?
For cautious investors, here's why this matters. Write down your maximum metals allocation as a percentage of your portfolio, then implement it gradually over weeks or months instead of days. That single step reduces emotional decision-making a lot.
And for the aggressive trader who sees this 14% hit and is itching to buy,
For aggressive traders, the important thing to understand is size smaller than your instinct and predefine where you add and where you cut. If you cannot write the plan on a single sheet of paper, the trade is probably too complicated.
I like that filter. If you compare that written plan with realistic position sizes, these swings in gold and silver shift from something to fear into something you can work with.
Exactly. Volatility hurts undisciplined portfolios, but for prepared investors, it becomes a tool instead of a threat.
So as we wrap, that gold whiplash around the US-Iran headlines gave us a perfect case study in why sentiment alone is unstable without understanding central bank behavior and ETF flows.
Right. And the important thing to understand is, if you only chased those spikes, you missed the real lesson, which was building a calm, rules-based plan for volatile metals.
Exactly. One-line takeaway? Treat gold, silver, and the miners as a long-term risk system, not a series of headline trades.
Warmly, if this episode helped you sharpen your playbook, subscribe, leave a quick review, and share this with someone who's been trading headlines instead of sticking to a plan.
And if you have questions or want us to stress test your scenario on air, email goldstandard@heymato.com.
With excitement. Next time, we're diving deeper into how those central bank flows spill over into silver and the mining space. That's where the real complexity kicks in.
Warmly, thanks for spending time with us today. Stay disciplined, stay curious, and we will talk to you soon.